Been a busy week for real estate news. You've seen the headlines about record sales numbers for the month of September in key markets, home prices hitting all-time highs in Toronto. You start to dig a little deeper, some interesting trends during the pandemic, particularly in Toronto. A lot of heat in detached homes in the suburbs, not so much in the downtown Toronto condo market. Let's take a look at what's happening there. Bring in Rob McLister, founder of RateSpy. And Rob, when you look at those condo numbers, Urban Nation had some interesting stats this week, and I know you opined on them on RateSpy about active listings surging for condos and rents falling. This is not a great formula.
No, things are getting dicey in downtown Toronto condos. You got record listings now. You got a sales to listings ratio that we haven't seen since the early 1990s. You got, people, investors liquidating because you got 14% drop in rents year over year. You get this flood of people to the burbs and more rural areas for more room, and you got end of mortgage deferrals this month and next. So you just got a lot of things working against the downtown Toronto condo market.
Now, of course, in the mortgage business, which you watch very carefully, we know that in times of record low interest rates, perhaps people will want to refinance for different reasons and access some cheap capital. You have this blog on the RateSpy site warning that if you live in the big city downtown condo, you're contemplating a refinancing, maybe contemplate that a little quicker. Why is that?
That's right, because I think we're in the very early days. We haven't seen a significant impact yet, but if the fundamentals bear out, and we start seeing these values come in significantly lower, then that reduces appraised values, and appraisers will factor in near-term trends in their valuations. So, if you got a $400,000 condo and the price drops 10%, that's $32,000 less that you can get on a refinance. And if the values drop enough, then all of a sudden you might be in a high ratio mortgage situation and not able to cost effectively refinance to reset your rate lower, despite all these amazing plunging rates we're seeing.
Now, for years and through the different waves of the real estate boom in this country, people have pointed to the condo market, the building that we've seen there, saying it's too aggressive, this will be the undoing, and condos kept gathering strength. So right now, I'm told by Urban Nation, this surge in listings leaves us about 5 months supply. Are we in a troubled space just yet?
I think you're going to see more listings. Listings beget listings many times. The psychology is souring in the market right now. I don't think it's the end of the world forever. Maybe things get a little challenging in the next 6 to 12 months. But when you see the immigration floodgates reopen, and you see all the deferral problems work themselves out of the market, you see employment come back, you'll see people starting to fill up the downtown condo market. But for right now, for the foreseeable future, you're going to have an air pocket in demand on top of just mounting listings.
Rob, I'm glad you brought up deferrals because I wanted to go there with you. We're hearing from certain bank chiefs are saying, don't worry, those people who had deferred their mortgages, they're back to making payments. Tiff Macklem, central bank governor, came out this week and saying, close to 800,000 households did defer payments, but they feel that the repayment, the resumption of payments is going well. What are you hearing? What are you seeing out there?
It depends how you define going well. So, are we going to see catastrophic defaults as a result of deferrals? No. But your typical economist out there analyzing this situation is projecting at least 10% of those expiring deferrals could be under serious pressure come first or second quarter of next year. So, I don't know if we're going to exceed the all-time high on record anyway of mortgage arrears, which was just over 1%. In the early 80s. But, we could exceed the 30-year high of 65 days. So 65 out of 10,000 borrowers, in other words, falling 90-plus days behind on their mortgage. I think we could potentially exceed that by the end of next year.
Rob, we are just flashing headlines right now for our audience. The province of Ontario reporting 939 new cases of COVID-19. The reason why I want to bring that number into our discussion, beyond just the concern that it brings to us, is that I was fascinated because the real estate industry was not shut down during the lockdowns. We shut down a lot of businesses, but you were allowed to transact in real estate. But, of course, people pulled back from the market because they didn't know what was happening next. As we see this kind of surge in cases, we wonder what the Ontario government's going to do about it. What kind of effect do you think it could have on real estate? Could we see that pull back from the market again, even without a formal shutdown of real estate?
Yeah, absolutely. I don't know if we're going to see the same pullback in listings that we saw in the first wave of the virus last spring. But it could pull listings off the market or some percentage of listings for a period of time, unless you have an overarching impetus that people are feeling that it encourages them to put their home or condo on the market much quicker. So right now, I mean, people aren't stupid. They're reading the headlines. They're seeing the fundamentals and what's happening in downtown Toronto, just as an example. Now you're starting to see it to some extent in downtown Montreal as well. But people are seeing kind of what's happening and feeling much greater urgency. So, keep an eye on listings this month and next. And I think we could be surprised at how much that sales to listings ratio deteriorates.
Now, Rob, I'd be remiss with having a conversation with you without actually talking about mortgage rates, because this was usually our bread and butter of our discussions. Again, with Tiff Macklem, he realizes, okay, we made money cheap. Cheap money is a big driver of the real estate market. We're concerned about the real estate market, but in the end, he basically said, this is not going to be our role to try to rein it in. They're going to keep money cheap. What are you seeing out there in terms of what's available in the mortgage land?
Well, for high ratio mortgages, now you're down to 1.44% in some provinces for a 5-year fix. That's just incredible. And, over half or just half of the rate that we saw, a year ago. It's just unbelievable. Now, the stress test rate, the minimum stress test rate, is still 4.79. The government talked about making that more reasonable so that it, followed the actual path of rates a little bit more realistically, and that hasn't happened. I think that, regulators are still a little worried about potential fraud in the housing market, and so they're taking their time on adjusting that stress test rate. I think that people are really excited about rates right now. I think that rates are going to go sideways here for a bit, but keep in mind that $3+ trillion in North American deficits, that eventually will work its way into rates and push rates higher.
All right, Rob, it's always great to get your insights on these matters. Thanks so much for joining us.
Anytime.
Rob McLister is the founder of RateSpy.